Hello and welcome back to the complete day trading course by Wealthy Education. In this video, I'm going to discuss how to identify market direction using EMAs. So what's an EMA? Well, an EMA is an exponential moving average. In order to know what that is, you would have to know what a moving average is. And a moving average is a line that shows up on your chart, and it comes in different periods. So for example, 20. And what it will tell you is, depending on what you select, normally it's the closing price, but it's the average closing price over the last 20 candles. And each little tick, little dot on the chart gets connected so that it's a big line. So the theory goes that if the lines are going lower, then the average price is dropping over the last 20 candlesticks, or 100 or 5 or whatever you're using. The difference between an SMA, which is a simple moving average, which is calculated exactly how you think it is, the average over the last 20 candles, an exponential moving average puts a little bit more mathematical weight on the most recent candlestick, so it tends to turn a little quicker. And that is what an EMA is. So there are a handful of EMAs that people tend to pay attention to. And in this case, let's go ahead. We'll click on indicators and we'll do moving average exponential. And I'll do 4 different ones because I'm going to be looking at 4 different speeds here. And what you see here on the chart right now is the 9 EMA, and that shows the last, in this case, 9 days. Really doesn't matter the time frame. So this right here is the average price over the last 9 candlesticks as far as the closing price is concerned. 9 EMAs typically are going to be used on shorter time frames, such as the 15 minutes. It just shows you the price is going up or down over the last time frames, in this case, last 9 15-minute bars. Now, the astute trader is going to say, well, I can see that on the price, and that's true. However, let's go ahead and change to 20. And you can see that the 20 is a little bit smoother, takes a little longer to change. And that suggests that perhaps the market's a little more stable than the 9 showed because it was going back and forth. There's also a very common one in the 50. And you can see that's much smoother. That shows basically a slightly trending upward market, which you could see from price. And then there is the 200, which is very common. Now, the thing about the 200 is that's almost always a daily thing. So the 200, the reason why this is important is because people recognize that there's 200 trading days for the year. So this is the average price over the last year. And you can see that it just kind of slopes lower as we've been in a downtrend. You can zoom way out. You can see that AT&T was trending slightly lower here for a couple of years and then really started to take off. Now, the average price of the last 200 candles takes a while to start turning, even with the EMA speed. So keep that in mind. I will format the 50. I will change the color here. And the reason I'm doing this is I can show you a very common pattern that technicians pay attention to. And that is this. This is the 50 EMA on the daily chart crossing above the 200 EMA. That is called the golden cross. That means that the shorter time frame, the 50-day moving average, is rallying and it's broken above the longer term average, and the longer term average is starting to turn up as well. That means both, in this case, intermediate, because 50 is not really short term, but it's shorter of the two. Intermediate and longer term traders are starting to hang on to AT&T, and you can see how quite well it did afterwards. This is where somebody using a moving average crossover system, where you would just buy on this crossover, would close out. And you can see that's a pretty decent move. That's from about 33 to 40. It's also when the quicker one, in this case the 50, breaks below the 200, that's called the death cross. And that means that a lot of selling would probably come, and you can see that we did break down. And why is that? Well, simple, because momentum in the shorter term intermediate traders is definitely negative, and now you're starting to see the longer term sellers come in. So golden cross, death cross. There are a multitude of ways to use these moving averages. There are some that are more important than others. On the daily, clearly the 200 is important because it's a year. But on short-term charts, you're going to find it really difficult to make that one matter too much. So I've gotten rid of the 200. Now we have a 50 EMA. So 50 hours doesn't have any mathematical significance, but it just gives you an idea of what's been going on the last couple of days here, last handful of days. Most of the time, though, what you're going to see is I'll make the 20 green. I'll make it a darker green than that. Okay. So I'll make the 20 green. And then the 9 is blue. Now, in this case, you can use this as a crossover strategy. And as long as you're trending, it does work quite well. I mean, that was a nice buy signal. And if you're a short-term trader, a daily trader for that matter, you really got in and out of the market over the course of a couple days on the hourly chart. Or you could even go down to say 5 minutes. And you can see that when you get a sudden blast higher, especially with this candlestick, as strong as it is, and the cross, you buy, and then you're in this market basically till the end of the day. Nice move. There is a couple of things that I would tell you about crossover strategies, though. They only work in trending markets. You need elevation or an angle down to get involved. So when the moving averages are tight like this, and they're basically going sideways, if you try to buy and sell every time it crosses, you get chopped up. However, if you see one break higher like this and all of a sudden they're starting to spread out and they're starting to turn up, that's an entirely different scenario. And that's where a lot of new traders get caught on these. They try to trade them every time that they cross, and that's not always a good thing. You can see how messy it is here. You can see how choppy it is here. The idea is, though, for every bad area, maybe that's a bad signal, you get a good one. That's a bad one. You get a decent one. You get a good one right after that. So the idea is that statistically it works out, but you are going to get in trouble with whipsaws occasionally. And that's why moving average crossover systems are good, because they do work statistically over the longer term, but you can have several short and small losses in a row unless you use some type of filter, and that's something that varies depending on the trader. With me, I like to see downtrending or uptrending to go along with the cross. Maybe a specific candlestick pattern. So like when we broke higher here, this hammer gives me a little bit more confidence. Major support and resistance, like we talked about in the last video, that helps as well. But to just go willy-nilly every time it crosses is definitely dangerous, especially if the moving averages are very tight. Because think about it, the 9 period and the 20 period moving averages being right next to each other suggests that the markets aren't moving much. The more spread out they are, the more you're starting to see rapid appreciation or depreciation of the stock.